Welcome back to another episode of Pro News. Let's kick things off with an update on the Fed's latest moves. Despite expectations, they kept the federal funds rate steady at 5.25%. But here's the twist. The tone they struck was definitely more hawkish than many anticipated. Digging deeper, the Federal Open Market Committee has nudged up their rate predictions for the coming year by a significant half a percentage point. So if you're thinking the Fed's in a hurry to up those rates, think again. This move reignites chatter that the Fed's tightening phase might not be over just yet. Now, with these rate tweaks, bond yields are soaring to levels we haven't seen in years, pulling capital away from other areas. This shift has triggered a stock sell-off and a mad dash to buy dollar assets. It makes you wonder, who needs equities, which are historically overvalued, when the safest bonds are offering the highest yields since 2007? Let's dive into gold now. Gold tried its best to stand strong, aiming for the $1,950 mark per troy ounce. But let's be real, the Fed's recent actions were a force to be reckoned with, pushing gold prices back down, hovering around $1,920. From a technical standpoint, gold's current behavior shows it's still in a bit of a slump. It's lingering near the top edge of a declining trend. If it continues this way, we might see it drop even further, possibly down to around $1,850. With the rising concerns about the US hefty debt, many markets are now thinking twice about holding on to US bonds and are looking for other alternatives. Could this be gold's moment to shine? Time will tell. Now let's talk stock market. Last week, it felt like the stock market was on the edge of a cliff. The Nasdaq 100 took a tumble, dropping over 3% after having such a promising climb the weeks before. It even touched 14,700 for a bit, nearing those support levels we saw getting strong buy-ins during June and August. So the big question on everyone's mind is, will the buyers step in again? Given the current sentiment around rising interest rates, it's a tough call. The sense is, if the markets continue to feel the heat, the Fed might just flip the switch on their policy, kind of like what we saw back in 2018. But there's always a but. Let's keep our eyes peeled for the next moves. WTI just doesn't want to back down. After touching $92 a barrel, it started to correct itself, but only took a brief dip to $88.40. And guess what? In spite of the stock market rollercoaster and the Fed's firm stance, black gold is making its comeback. A lot of this buzz might be because Russia's hinting at limiting petrol and diesel exports to level things out. But let's not overlook the ongoing oil shortage either. Just think about it. A surge in oil prices by over 30% in the past 3 months? That's throwing the big I word, inflation, back into our chats. The Fed keeping options open for future rate hikes? This could very well be why. Alright, diving into the world of crypto now. It's been kind of playing tag with the 50-day moving average for the last week, but come Thursday, after peaking at the post-Fed ripples in stocks and bonds, Bitcoin took a step back. Now, let's not sound the alarm bells just yet. Bitcoin pretty much looped back to where it kicked off the week, sitting around 26.6K. But here's the thing with the crypto realm, and it's a bit of an unspoken rule. If it's not climbing, it might be sliding. With folks potentially looking for safer bets, don't be too surprised if Bitcoin flirts with the 25K mark soon. And if the buying crowd isn't feeling it, we could see a tumble down towards 20K. Just some food for thought. Okay folks, let's mark our calendars for next week because all eyes are going to be on Germany. We've got some big numbers coming our way: economic sentiment, unemployment stats, and wait for it, September's inflation estimates. Now, if we spot any cracks in these figures, the euro might just keep its downtrend going against the dollar, especially after its recent rough patch over the past 2 months. But hey, silver lining, positive vibes from these reports might just give the euro a bit of a boost. Now, jumping stateside, set your reminders for Tuesday evening. We're getting a peek at the US consumer sentiment. And keep an ear out for durable goods orders too. Remember last time around, both of these numbers were, let's just say, not too cheery. If we don't see it bounce back soon, it might just be an early warning bell ringing for a recession. Let's keep our fingers crossed and hope for the best. And there you have it. Another week, another roller coaster of financial twists and turns. Stay informed and stay ahead.